Hi everybody, this is David Marsh. Today is December 7th, 2016. In this video, I'm going to go a little more in depth about the new subscription-free futures trading program that we're starting here in a few weeks. I'm getting a lot of questions about, what exactly are you doing? Is it like the weekly service? Is it this? Is it that? What kind of trades can I expect? What kind of profits can I expect? All very fair and good questions to ask, and I want to try to answer all those questions here. And the first thing you have to understand is that I am not trading weeklies in this service. I know I've made that clear. So you should not expect to have closed out winners every week or closed out losers every week. With my SPY service, with weeklies, we have winners and losers, but they close every week. That will not happen here. In fact, you shouldn't really expect to have profits the first 1 to 2 months. I'm not saying you won't have profits. I'm saying you shouldn't expect to have profits. And that's because I stagger into my positions and I go 60, 90, sometimes 120 days out with options. All right, so I'm trying to collect time value. Now, I do that with the SPY service. I've done that with other trading things that I do. Many of you may already sell premium and you understand all about it. Trading commodities is a little different, but well, let me just get into it. And I think when I go through some of these examples, I think you'll understand better. And again, if you sold premium in the past or you do it now, you already understand most of what I'm going to talk about. But many of you just don't understand it. So I really want to go again a bit more in depth. So you understand. So I've got a couple of trades up here I'm going to show you. These trades should not be construed as trading advice. These trades are not trades that I'm presently in. I just put 3 random positions using 3 different strategies that I will use. I do have a lot of different strategies that I use, and I'm going to show you 3 examples now, but these are not real trades. They may become real trades at some point, but as of right now, they're hypothetical examples for the sole purpose of explaining to you what it is I'm going to do with this service, okay? So let's look at the first one. Well, let's look at crude oil, okay? This is a risk graph, which I'm sure you've seen on many a times with any of my other videos. You're probably used to my Thinkorswim platform. I'm not using Thinkorswim for futures. But this right here is a simple vertical spread. It's a vertical call spread where I sold a call option and I bought a call option that expire on the same time. Not a strategy I'll use all the time, but it is a strategy that I will use from time to time. One of the good things about vertical spreads is the margin's very reduced because you determine your max loss before you ever get into the trade. So margin on this trade is only $397. That's going to be about the cheapest margin trade you're going to see, at least tonight in this video. But also my max profit's only about $180. You can see down here. Let me just give you a quick overview. This is the option view software. This line up here where it says 180, this is expiration. This is your break-even line. And these little dash lines represent today. And this dotted line represents today. This dash line represents 50 days from now, okay? Right off the bat, you're going to notice that, let's say the market moves up 10% and goes right here to, well, $58, okay? If we're not at expiration, we're going to be taking a loss, okay? We will not see that profit until time decays and we get closer towards expiration. This is what I mean when I say you should not expect to see a profit the first month because, again, I have to build these trades out. And I don't think I mentioned it. I may sell options in the March contract. I may go out in every 30 days, add more contracts to that, to where after a couple months of doing this, of building, if you will, every month we'll have expiring options and profits and losses in some cases coming into our accounts. But until that happens, we have to build it up. And in a case like this is using call options, the only way you're going to instantly see profits, remember I said that there may be times you will, is if the market goes down instantly, okay? I am not trying to pick direction with this system. Okay, let me repeat that. I am not a directional trader. I am simply trying to collect time decay by using options I believe the market is very unlikely to go. I figured those strike prices out by using fundamental and technical, okay? When you trade spiders and stocks, sometimes technical is all you need. But when you trade commodities, soybeans, corn, wheat, you need to know what really happens in those markets, okay? So it's really a two-tiered approach, if you will. I don't just go out there every month and pick a couple strikes that look good and just start selling options against it. That's not what we do. But if you put on, say, a call spread and the market does go down, you will start seeing profits very, very quickly, in which case there'd be no reason not to take our profits early and close them out. But if the market were to go up, that is not a negative sign. That's not, oh man, these trades aren't looking too good. No, these trades are doing what they're supposed to do. These trades are going to move. The market's going to go up, market's going to go down, but over time, time decay is going to become our friend. That's why, for example, you'll see today we're taking a loss, but over time it's going up, and all of a sudden the loss becomes a gain. That's very important to understand, because when we start in a few weeks, we're going to open up 1, 2, 3 positions, and they're probably going to go underwater right off the bat. And you need to understand why. That does not mean it's a bad trade. It just means the time hasn't happened yet, okay? So very important concept to understand that I can't not emphasize enough, because so many people miss this. They just don't understand. And I understand you may not be an options trader. That's why I'm doing this video. You may not understand how theta works, okay? But that's why I'm showing you that as long as the market stays where we need it to stay, at expiration, we're going to make money, all right? So, again, this vertical spread is not something I'm going to use all the time, but it is one of the 3 trades I'm going to show you tonight. So that's crude. Let's move over to coffee. Okay. So coffee, I'm using a ratio spread. Now, this isn't to say I wouldn't use a ratio spread in crude, or I wouldn't use a vertical in coffee. I'm just showing you examples, okay? Now, this trade actually may come to be a trade at some point if coffee keeps doing what I think it's going to do. Now, in this trade, you'll see it almost looks like the vertical spread, but you'll see we have a little peak here where we actually start making a lot more money. Now, margin on this trade is going to be a little higher. Margin on this that doesn't seem right. Yeah, it's only $726 on this trade. But I'm going to double check that because I'm not sure. Let me pause for a second and double check this. All right, I'm back, and here's the margin here. It's going to be somewhere around $1,100, generally somewhere in the middle there. So that actually was pretty accurate. Let me go back to the risk graph here. So with this trade, obviously, if coffee starts to go up right off the bat, we will start showing a profit. And that's great. There's going to be trades that are going to do this. You know, again, I'm not placing a bet that says coffee's going to go up, because coffee can go down. In fact, coffee can go down a lot, and I'll make more as if it stayed here. Like, here's a $1,200 gain. I can make up to $1,800, $1,900 right here. So I am not making a directional trade at all. But if it does go up, because I'm using put options, market goes up, we will start seeing profits quickly, in which case we would simply close out the trade, maybe move into another expiration or move up our strikes. There's so many different ways we could do that. But if the market were to move down, we're going to show an unrealized loss, right? And again, this is just showing today. I can show a couple more lines. This would be 50 days, et cetera, et cetera. But again, let's say coffee were to go down 10%, we're showing an unrealized loss. That's not something to freak out over, okay? You guys all have my phone number. You're always welcome to call. But this is, again, why I'm explaining this is not saying, oh, man, that coffee trade doesn't look too good. We're losing money. No, we're not. The trade needs time to cook. These trades will be cooking for several weeks. And over time, this line will move up and become this line. Now, if the market goes down 20%, yes, we're going to be losing money. I do not allow my options to go that far in the money. So is there risk in these trades? Absolutely, there's risk. but I do not allow my trades to go way past the break-even point. There's no reason to, especially when we have 60 days left to expiration. But that's something you don't have to worry about. That's something I worry about, okay? So with this position, very little margin, max profit. Well, max profit in this range is $1,200. If the market were to fall down towards expiration, we could actually make a little bit more. So this is the ratio put spread. Let me go to one more example here. Let's look at nat gas. Very likely this will be a trade I will be placing for myself. And it's possible if the service is running and nat gas is where it needs to be, you may see this position as well. This one looks really nice. I didn't want to turn this into a big charting thing, but let me just show you a quick chart of nat gas. Again, technicals and fundamentals, okay? So here's a thinkorswim chart of nat gas. And let me just kind of zoom in here. Let me go back 5-6 months here. We've been kind of floating around here, and we broke out and really broke out strong. And now we're starting to weaken up a little bit. There are some things this time of year that you need to watch for nat gas, and I'm keeping an eye on those. But I don't believe we're going to go much over where we are now. Maybe not much over $4. And you can see that even if we do go over $4, we're still in really good shape. In fact, $4.32. Now, I know that doesn't seem like a lot. Nat gas trading at $3.50 or $3.70 going to $4.50. Think about the gas pump when you go pump your gas. If you pay $2 a gallon, next day you pay $3, you're like, holy moly. Kind of like the same thing. Okay, so going from 350 or up to 450 would be a very, very big move. So, but in any event, in this case, we would kill it. You're talking over 100% return on our money. So up to 180% return on our money if nat gas kept going up. Good thing if nat gas just went down or just kind of stayed in this area here, we're going to keep collecting our theta. And we can make up to $885 on this position. And that's with a $1,200 margin. Okay? So the returns on this, based on your margin, are pretty substantial. You're putting up $1,200, sometimes $2,000, $3,000 to make $2,000 or $1,800. Okay? So the overall plan, guys, is the first couple months, we're going to build our base. Okay? And I've told many of you over the phone that you have to be patient. We may start January 1st, for example, and you may not see a trade the first week or the second week, maybe not the third week, okay? This is not about how fast I can put these trades on. That's not what I do here. It's about properly placing these trades by using the right technicals, fundamentals. When everything is in place, I execute the orders, okay? Then we'll try to get 2 or 3 positions open. Let's say, for example, crude, coffee, nat gas. Just things that we're looking at right now. Well, the following month, we may put on some more positions in the same markets. So we may add to coffee, maybe add to nat gas. Maybe we don't move to crude. Maybe one goes into profit and we take some profits, right? And now we've added another position to say coffee and say nat gas, and we closed out crude, we'll say. We may open up a third trade. Maybe corn is coming into play, or soybeans or hogs are coming into play, and we may open another position there. Well, now come the third month, we may open up another coffee trade, but now we'll start closing out our first coffee trades, okay? So we're going to kind of stagger into these trades to where at some point, once we build up our base of, say, 4 or 5 positions, coffee, crude, wheat, pick 5, okay? And I don't mean it's going to be 5. It's going to be somewhere in that area. It might be 6, it might be 3, it might be 8, okay? But then every month, once we build them, we'll have expiring options, okay? Expiring options is a good thing when you're an option seller. That's when the line's up here. That's what you're looking for. We are trying to let these options expire worthless. So if we bring in a $1,200 credit, we want to keep the $1,200 credit. However, we're not greedy. If we see, something like this, if we all of a sudden get a big drop down and we've got $700, $800 in the first 30 days, I'm more apt to take the money, reload the position later when something else happens. Okay. But again, on the other side of the fence, market comes up here, let's say nat gas moves up another 20%, which is a huge move. It looks like it's underwater now, but over time decay is our friend. This is a very important concept to understand. So this is a diagonal spread that I'm looking at in nat gas. Diagonal spreads is something I use weekly with the SPY service. It's not something I'll be able to do all the time because of the pricing in some of these options. So when you're selling a February and trying to buy a March or an April, depending on what contracts are open for that symbol, sometimes those long-dated options are just so much money, it eats up all your credit and they just don't work. But sometimes they do, and here's a really good example, which is why I said this trade may very well be placed in the very near future, because it's one of the ones that just happens to work out really nice, and you don't lose money unless the market moves up 36% more. And even at that point, there's things I can do with rolling adjustments and all that. So let's just recap. I know we're already 16 minutes in. I really thank you for your time. I do, but it's important to understand that the first 1 to 2 months, you should not expect to see profits. We covered that. Although you may see profits, and we covered that as well, because the market may just go in our direction, even though we're not directional traders. If they go in the opposite direction of the strikes, we're going to start making money. It's just the way it is. So sometimes that's going to happen. Sometimes they're going to meander around here or go up a little bit, and you're going to see an unrealized loss, and over time it should turn into a realized gain. Okay? But this is important because I know some of you guys are going to get a little nervous when you say, geez, I've been in this service for a month and a half, and I've only lost money. Let's say I started with 100,000, and we're in 2 or 3 positions, and now my cash value is 93,000. Geez, it's you've done nothing but lost money so far. That's not the case, okay? I know I've said this 3 times, maybe 4 times, because these questions come up, and I can't emphasize enough that make sure you understand what this is, because it's your money. If you decide, hey, I want to quit this one day, that's your business, okay? But I don't want you to put yourself in a spot where we're in a really, really good position. It's just time hasn't decayed, and you think we're losing money. And technically it is, but over time we get all that money and some back, okay? That's what this is all about. All right, so first couple months are going to be slow. We're going to be building positions, not trying to sound like a broken record, but I want to make sure you get it. But once we get going, you should start seeing trades close every month, okay? My percentages on this are about 85%, so we're gonna take some nice winners. Over the course of time, we're going to start having winners close every month. We're going to have a couple losers too, all right? We're going to have some losers. But again, and I'll cut it short here. Well, I guess not cut it short. I'll cut it long. I'm not going to let the market go all the way over here. There's no reason to. When you're trading weeklies, well, I don't trade verticals and weeklies for this very reason, but when you're trading weeklies, there's only so much you can do. You've only got a couple of days. But when you're trading 90 days out, there's plenty of options, no pun intended, that I can do to, and some of you know this, okay, to correct this, adjust the trade, and put us right back in a profitable level. What that really means is we've closed out a small loser and open up another trade with strike prices extended out. That will happen from time to time, and that works most of the times anyways. But, all right, in any event, I hope I've answered your questions. I hope I didn't add any more confusion to this. But this is, in a nutshell, 3 of probably 5 or 6 different strategies that I use for trading options. Again, long-term options. It's a completely free service. Trey is going to pay your fees for the first 30 people. So, and if you have any questions, if this still doesn't quite make sense and you want to talk about it, feel free to call me, email me. We can set up a time to talk. And, 20 minutes on the dot. So we'll go ahead and leave it there. Thanks for watching.